I just happened to buy a brand new life insurance policy like 2 or 3 weeks ago. And I'm telling a lot of people about it because this is a really big move for me. It's a game changer because the policy is owned by my business. So I want to take you guys through the process of why I bought a life insurance policy through my business on myself. Okay. And I want to show you the actual policy design, why and how am I paying premiums for the policy? Does that make sense? So you're either in the information stage or maybe you just got a policy and you want to make sure that it's built and designed right.
The technical
You
stuff.
guys are ready for that. I mean, if you're watching on Instagram, definitely might want to go ahead and click that link in the bio so you can get access to the Zoom so that you can actually see what it is that I'm talking about tonight. All right. With that being said, first things first, because a lot of times I get a question, hey, Brandon, what life insurance company is the best? Which one should I use? Which ones do you use? That answer could change based on who you talk to, what your specific situation is, because some insurance companies are better for some things, whereas other insurance companies are better for others. I happen to go with this specific company because it is the seventh largest insurance company in the United States. They're A plus rated. They have a 96 Comdex score. They make the loan process extremely easy, and they really cater their business towards business owners. So if you have a business, then this might be a good insurance company, a good insurance product for you. All right. Now, a couple of things that I want to highlight before we get too deep in this conversation, especially if you were with me last week. The first thing you're going to notice is the initial death benefit, and that's actually set at $1.5 million. So if you guys remember last week, I said that if you ever see an even death benefit, then there's a good chance that your policy is not designed for max cash accumulation. Okay. And that's for most people. I happen to be an agent. There's a method behind the madness. This is the actual product. As you can see, it's an IUL. It's on me at a preferred rating. And the actual annual premium is $24,000 per year. Now, an IUL has a flexible premium. Flexible premium means it can change. And it can change based on what you want. You'll have a minimum premium and a maximum premium. The minimum premium is set by the insurance company, which is going to be ultimately what you want to contribute or what you intend to pay into the policy. Whereas the maximum premium is going to be set by the IRS. And the maximum is really based on the size of the death benefit, it's based on your age, it's also based on your health rating. Okay. So just so you guys know, this policy can take up to $100,000 per year without creating any tax consequences. And that's going to be important because ideally, when you have an IUL, you want to pay the maximum amount of premium into the actual contract. You don't necessarily want to put in the least amount of premium in the actual contract. That's because the cost of insurance increases every single year. So if you're paying the minimum every year, your minimum next year will be higher. And the next year, your minimum will be higher. And the older you get, the higher your minimum will be. That's why it's key to always overfund. Actually, overfund means you're doing too much. You want to max fund. Now what we're going to look at is the actual illustration, and we're going to work through this from the left side to the right side. We got year one, age 37, which is my current age. You're going to have the premium outlay, which outlines how much expected premium is going to go into the contract for the year. And as you can see in the first year, I'm planning on putting $24,000 of total premium into the policy. Now, Brandon, why are you putting $24,000 into the policy? This is very important. I want my business owners to understand this. As a business owner, you do not have a retirement plan. Your business is your retirement plan. So you need to take some profits and you want to set those aside for one day when you go to sell your business or one day when you want to maybe take a step back from the business and just different things like that. So what I do as a general rule, 10% minimum will be saved towards my policy. Now you can do more than 10% if you want to do it. It really is based on your personal preference. And that leads me to the number one question is how much does the policy cost or how much is the premium? The premium can be any number. General rule, 10% of your net income should be applied towards premium. General, okay? And again, that's going to be different for everybody, okay? So in the first year, I'm putting $24,000 of total premium in the policy. This very next column where it says partial surrender, This is a column that would have numbers in it if I decided to surrender some of the cash value and death benefit of the policy. Typically, you will never do a partial surrender. Next column is going to represent loans. So as you know, there's ways you can get money out of the policy. Probably the best way is going to be a loan. I'll cover loans a little bit later tonight. And then you got your loan interest. And then the last one is net outlay. And so your net outlay is pretty much the difference between what you paid in premium minus any loans or surrenders is your net outlay. So in other words, let's just say I wanted to take out 10,000 as a loan, or if I wanted to partially surrender 10,000, then my net outlay would be 14,000. Is everybody tracking that? Okay. Now in all IUL policies, you'll have different assumptions because they're not based on guarantees. Your guarantee is 0% in an IUL, okay? And so what the insurance company does is they give you two hypothetical scenarios. Scenario one shows your policy earning 3.5% interest crediting per year, which is typically going to be whatever the cash account or the general account of the insurance company is paying. And you can get that without any market risk. If you just want to get a guaranteed locked in 3.5%, then you can just choose that strategy, all right? Whereas using illustrated credit rates, this is actually going to be based off of the S&P 500 index, if that is the choice that you selected for your cash to be linked to in terms of the crediting. Does that make sense, everybody? Good. All right. Now, with that being said, I want to direct your attention to the far right, these last three columns, because I want you to look at the cash value, the surrender value, and the death benefit. Your cash value is going to tell you how much money you have in your policy minus your costs. This is the net number. So basically at the end of 12 months, after I pay this $24,000, I have $18,962 of cash value, assuming I earned this 6% illustrated crediting rate per year. Does that make sense? Now, the next column where it says surrender value, this is what I can access of my cash value. So as you can see, I have 100% access to my entire cash value from day one, right out the gate. So for business owners, I know business owners, you know, you got to have capital, you got to make moves, right? You need a retirement plan, but you don't need your money tied up in a retirement plan. That's why this is a solution, because there's no penalties, taxes, or restrictions on accessing the capital out of the contract. So that's pretty much what I'm planning on doing the first year. All right, now in the second year, you guys take a notice at how the premium jumps up from $24,000 for the year to $176,000 for the year. So the reason why I want to put in $176,000 in the second year is because my max premium for the year is $100,000. How much money did I put in the first year?
24,000.
24,000, right? Because I didn't put in $100,000 in the first year, that means I can add the additional in the second year. So I'm going to put in a total of the $76,000 that I didn't put in the first year, plus another $100,000. Okay. Now, let's take a look at the policy loan. I'm going to put in $176,000. I'm going to take out $150,000. Guess what I'm going to do with that $150,000? You guys guess. Where my business owners at? If y'all had $150,000, what would y'all do?
Take a loan out.
Well, let's assume the loan is already out. This is in my bank account.
Real estate.
Yep, real estate. There you go. Real estate. I like that. That's a good one.
Get another policy.
Another policy. I like that. Any other ones? Any other guesses?
Pay bills.
You said what?
Pay your bills.
You said pay benefits?
Pay bills.
Oh, pay bills. Yep. Exactly. All of those answers are correct. Because the point is, I can do whatever I want to do with that money. You can do whatever you want to do with that money if it's your policy, right? So what I'm doing is I'm taking that $150,000, I'm putting it back into the business to pay for things like rent, to pay for things like employees, to pay for things like office supplies, to pay for things like payroll, to pay for things like, I don't know, pay for whatever. There's a lot of stuff you can pay for with that. Does that make sense? So Brandon, why are you borrowing that $150,000 from the policy instead of just paying for it in cash? The reason is because my money is more expensive to use than the insurance company's money is. or the insurance company's money is cheaper to use than using my own money. And this is where a lot of people get messed up because they hear the word loan and they hear the word interest. And I know a lot of us got bad experiences with loans and interest and credit cards. But what you got to understand about a policy is that it is a secured non-recourse loan. Essentially, what that means is you don't need to use your credit to apply for it. It's your money, right? It means you don't need to have a certain amount of income or debt to income ratio in order to get access to your money in your policy. It also means that you don't have no monthly payment. None. Okay. Now, let's just say that this loan cost me 4.5% for the whole year on that $150,000. Well, that's how much interest I would owe right there. But if you come back over to that far right-hand column, you'll see my cash value is at $189,353. This cash value is growing at an average 6% per year. So even though I took out $150,000 of loan or cash from the insurance company, I still get to earn interest on my full cash value as if I never took a loan. Would you pay 4.5% interest to earn 6% interest?
Yeah.
Yes.
Right. Exactly. And that is the whole concept. If you can understand just that piece right there, then you got it. Okay. So essentially what I'm doing is I'm taking my business's revenue, my cash flow, I'm putting as much of that money into the policy as possible, and I'm going to take out enough to continue running my business. But I'm going to leave a little bit in because I need to set some money aside for my retirement. You guys got it? Now, again, let's go ahead and let's take a look at this loan balance because, Brandon, when does the loan get paid back? Remember, I said it's not a mandatory repayment. You guys see how that death benefit reduced from year 1 to year 2? That is because the insurance company is going to use my death benefit to collateralize the actual loan. Does that make sense? Which means I can borrow money again because the next year we're going to put in another $100,000. But this year I'm only going to take out 80 and I'm going to add another 20 to pretty much my cash value or to put away for retirement purposes. That brings my cash value up from 189 to 293. And my surrender value to 50,560. So remember, this surrender value here, I can use it any point in time. It doesn't have to stay there. If I need to expand the business, I can go ahead and dip into those funds, expand the business, but ideally I probably would pay it back. Does that make sense? I probably would, at least this early in the contract, right? And then again, you'll see the death benefit be reduced in the 3rd year, as well as in the 4th, and in the 5th, and in the 6th, and in the 7th, and then you'll start seeing it come right back up here in the 8th year. So pretty much what's happening is what? What's happening? Let's pretend I had a bank account right there, and this is my revenue.
Hey, so you're taking loans against taking policy loans, but in the 5th or 6th year or 8th year, you begin to pay it back, or what is that saying?
What part are you looking at?
Well, when you see the death benefits are beginning to increase, it decreases and then it increases in the 8th year.
Very good point. What was the starting death benefit? 1.5 million?
Yes.
All right. So you can never have more cash value than death benefit. If your cash value grows too fast, the insurance company will automatically increase the death benefit. Okay. So once you look at year 9, year 8, or between year 8 and year 9, I'm already at $900,000 of cash value, which is way, way too much cash value for that $1.5 million death benefit. So what the insurance company does is they automatically will increase the death benefit because there always has to be a space between the cash value and the death benefit. That's called the corridor. If you fail the corridor test, then basically your policy loses its tax advantages. Pretty much your policy will be treated almost like an IRA or a 401k to keep it simple. And that's what you don't want. Now, this is something that you don't have to like monitor that. The insurance company automatically adjusts the death benefit for you because they don't want it to become a taxable event. So that's essentially why you see that death benefit start to increase again. Okay. And it's not really that it's increasing again, because in year 2, 3, 4, 5, 6, 7, the death benefit is still 1.5 million. You're just seeing the loan balance. That's what you're seeing deducted off of that death benefit. You guys following it? Yep. Okay, good, good. Now, at this point, let's just say I continue running this 100 grand a year, saving my 20 grand, like my own personal IRA, or it's my business bank, not the family bank, this is the business bank right here. We're gonna go all the way out to age 62. So what's different at that year, at age 62, than the previous year? We're still putting in 100,000, but we're taking out 225,000. That is retirement income. Because a lot of times, even if you have a business, at least from my experience, business owners, when they no longer want to work in their business, they'll structure a deal in a way to where they're getting some type of cash flow or some type of revenue from it, if they don't just outright just sell the business and just get a big lump sum of cash. What I did in this scenario was just keep a conservative projection, as if I only got $100,000 of cash flow per year, just passively from my business through some type of structured deal. But because I have this cash value over here, and I kind of skipped that part, you see what the surrender value is? 1.3. I see that 1.3. Yep. All right. And if you guys take a look at what I put in over that same time period, just a little bit over $500,000, right? My $500,000 basically 3x, almost 3x in that 25-year period. Okay. Now, technically, I could use all of that cash at one time if I wanted to, but if I'm smart, I'm not going to spend it all at one time. You see what I'm saying? We want to treat it as a supplement to our income. Okay. And basically, I'll be pulling this out from age 62, and then it runs through age 93 before I run out of money. Okay. So hopefully I don't run out of money. You know what I'm saying? I might have to take out a little bit less, but I don't know how much stuff I'm gonna be doing at 93 anyway, to really be spending money like that. Probably be giving it away to the grandkids and the great grandkids, and probably other people's kids at that point. Y'all feel what I'm saying? All right. So I hope that gives you just a quick background of how you could potentially structure a policy. It's mostly about how you start it. The important piece is making sure you start it with a comfortable amount that you can manage initially. Okay. And again, remember, like I said, about 10% of your income is like a general rule. And what's good, if you're already saving 10% of your income, then you're already in the perfect position, because it's likely that you already have cash available and you can just front load a policy, right? The reason why I didn't front load this policy is because I got like 6 of these or 7 of these. So there's money in different policies. And so I was like, you know what? I'm just going to build this one up slowly. But then next year, the plan is to begin leveraging this policy and leveraging my business's income through the policy and finance my business through my policy. Okay. Any questions?
Yes, this is Femi. Can you hear me?
Hey, what's up, Ola? How you doing, man?
How are you?
I'm good, man. Been a long time.
Oh, no question. I was on yesterday.
Okay.
Real quick, when starting this same concept, let's just say it's a business, right?
Uh-huh.
Are you signing it under, let's just say it was Femi LLC, not under the personal? 2 things I wanted to ask, as far as the maximum premium can be structured under a business, and will it now read under your tax ID number?
So what'll happen is the business will be the owner, and
Correct.
then you would be the insured, right? They would need the business's tax ID number for the application. Yeah. So to answer your question, yeah, you would need a tax ID number. The policy would be structured under the business. Most likely there will be a W-9 form that will be filled out as well. And as far as qualifying for the premiums, you really just need to state the income, depending on the amount or the size of the policy. Like if it's let's just say you're trying to get a $5 million policy and the premiums are going to be like $500,000 a year or something like that, then you're going to have to show some proof that you have that type of income, right? But for a policy like this, it was just stated. They just needed to know how much money my business made last year, a general idea, how much money is made this year, and then like what are the assets of the business or how much cash does the business have? And then that was generally enough to just go ahead and qualify for it like that.
So is it safe to say that depending on which carriers you use and things of that nature, this policy can be used such as like a key man?
Yeah, it can.
Okay.
Yep, it can. That's actually a question on the application. Are you structuring that as a key man policy or an executive bonus policy? Mhm.
Okay, that's beautiful.
Yeah, yeah.
I appreciate that. That's good news to hear.
Yeah. You can even swap out the insured person. So let's say, for example, that I don't want to have this policy anymore, but I don't want to surrender it or lose the cash value. I could remove myself as the insured individual and give that over to somebody else, probably another employee or like a key person in the business. Now, I still own the policy, but the policy is on the life of an employee of mine or something like that, or on a family employee. So there's even things like that you can do. That's actually really new.
Okay.
Yeah, that's good. Let's see what else.
Would they have to go through a medical exam?
Yeah, they would have to qualify medically for it. Mm-hmm.
Thank you.
Actually, I think I got to double check on this because I believe there's a way that they can do it without a medical exam, but you're going to pay a higher premium for it because the insurance company, they will like their risk averse, right? So if there's no medical exam, then it's like, well, we got to charge you more for that because we don't have a really good idea like on life expectancy and health. So they'll factor that into the actual cost. There's even designs where you can get 100% of your premiums back if you cancel it within the first year, but it has to be a business-owned policy. But I don't think most people would cancel this type of policy if they had it. Really, you just needed to show good numbers. If you're applying for like financing, a lot of times banks will ask if you apply for like business credit or business loans, they're going to want to know what cash assets you have, right? Life insurance just happens to be one of those assets that can, but only the cash surrender value, not the death benefit. So the bigger the cash value is, the better it looks on your balance sheet as a business owner.
And what's the rider that you was referring to yesterday that allows you to borrow against the cash value early? It was early something?
It's just an early cash value rider.
Okay.
Some companies have it, some companies don't. It's an optional rider. It does come in an additional charge, like a rider charge.
Correct.
But I just think it's worth it.
Oh,
If
yeah.
you don't use it, then you're probably looking at maybe having access to 30-40% of your cash value in the first year. There's a charge on that. It's an opportunity cost on that, not being able to use it. Yeah, good question.
But
Speaking
the early
of charges,
But the early cash value allows you to get what percentage, up to what percentage of it, and how quickly?
it just removes the entire surrender charge. So whatever your cash value is, you have access to it.
Okay, makes sense.
Mm-hmm. Let's take a look at what it costs. What does it cost? And something that I forgot to mention up here. You guys remember I said that this column was illustrating 6% on the cash value and then 4.5% on the loan. You guys remember that? Yep. Yeah. No.
Yep. Yes.
Okay.
Yes.
Okay, cool. It's only showing 6% interest in the first year. In the second year through the rest of the policy, it's showing 5% interest credit. So what that means is it's not a 1.5% spread like I told you guys earlier. It's only a 0.5% spread between the cash value and the surrender value. So let's just think if you were to get 1 or 1.5 or 2, what these numbers would look like. Well, common sense would say if it's 1% as opposed to 0.5%, we should have double the amount of cash value here. Does that make sense? So just something to think about. This is an extremely watered down illustration, which is why I think next week when we actually look at the credited rates, you can be like, man, I can't believe nobody else is doing this. It sounds way too good to be true. I try not to leave no stone unturned. Like I done looked for years trying to find something wrong with this, and I ain't found it yet. Not saying that it's not. So if anybody's on Instagram or on the call that feel like they can find something wrong with it, please let me know, because I really want to know. All right, and that's that. Now let's talk about the charges.
Can you write off the monthly payments for the business owner on as far as taxes?
That is a very good question. You can write off the premiums, but somebody has to pay the taxes on it. For example, let's say if you structured the policy as an executive bonus plan and you wanted to basically pay a bonus to your employee or to yourself as the premium into the policy, it's a tax deduction for the business, but it's going to be taxed to you as earned income. At least in an LLC. Again, I'm not a tax advisor or a CPA, so you may want to consult with them because they may know something I don't know in regards to how you could potentially deduct the premiums that you pay for the life insurance policy as a deductible expense of your business. That's a really good question.
And then Jeffrey, do you got a question?
Hey, yeah, great to meet you, Brandon. I was on the call yesterday as well.
What's going on,
And-
Jeffrey?
Hey, yeah, you too, Anthony. So one question I had, you were talking about policies for a business and you're talking about multiple policies. I've heard with IULs, someone has 5, 6, 7, 8 different policies. Now, is there a difference with doing that versus just having one bigger policy? Like, is there something I'm sort of missing? Does that make sense?
It does. Really, it's personal preference.
Okay.
I started out originally and I just had one personal policy. It was just on me, right? Then from there, I got my wife a policy and I got my kids policy. So that's how I got to 5, right? But then when I started the business, I started realizing that I had personal income and I had business income. And it just made more sense to say, Brandon, why don't you go ahead and open up a policy so you can capture more of the business income through that policy. Let me give you a vision of what it means. It's really just a strategy.
And just to piggyback on that, covering multiple lives, like multiple members of your family, you can look at that as a tactic to buy more death benefit for the family, especially if you have like kids. The more insurance, or as long as it has insurance, then for sure those premiums are gonna go back into or be passed on to the next generation. That's the tactic too. Instead of just buying like one huge policy for yourself, you could break that up evenly between the household.
Yep, exactly. Let me break this down real quick. So I have an LLC, and the LLC is actually a partnership. I'm one of the members of the LLC, and then there's a business trust that is also a member of this partnership. And so let's just say that the LLC had $1 million of revenue for the year, not profit, not $1 million profit, but let's say it had $1 million of revenue or income. All right.
Okay.
What we just looked at was what $100,000 a year would do flow through an IUL policy. But what do you guys think $1 million would do? 10 times as much, right? So what I want to do is I want to take this full $1 million and funnel it through an IUL, right? So that's why I have one IUL here, because at some point I want to be able to take this full $1 million in my IUL. So it goes in, earns 6%. Well, not 6% guaranteed every year, but hypothetically, assuming everything we know, we can expect 6%. That's why if we come next week, we're going to look at the real numbers. You're going to see how realistic that 6% projection is. All right. So premium goes in, earns 6%. Let's say I take it all back out, all $1 million back out at a cost of 5. That's 1% on that $1 million. So that's policy number 1. Everybody with me? Okay. So now the business has expenses. Let's say out of that $1 million of revenue, there was $500,000 of business expenses. That would leave $500,000 of profit. Well, what do we do with the profit? Well, at least with the LLC, the profit will generally pass to whoever the members of the LLC are. So this trust happens to be a 90% partner, limited partner of the LLC, which means it's going to take its share of the revenue, or $450,000. Everybody tracking? Whereas the other 50 belongs to me personally. All right. How many people know what a trust is? First of all, let's start there before we get too deep down here. Kinda? Okay. So a trust is basically a 3-party contract where you have a creator who creates a trust for the benefit of a beneficiary, right? And so a trust has three individuals, right? It has a grantor, it has a trustee, and it has a beneficiary. And so typically the way it works is that the grantor will put something inside of the trust, whether it's house, money, intellectual property, whatever. They'll put that in the trust, and the control passes to the trustee. So the trustee doesn't own the assets or anything like that. They control it for the benefit of a third party. And so usually you'll see a trust in estate planning for people that are wealthy, that have a bunch of assets. They want to leave it behind to their beneficiaries, but maybe their beneficiaries are irresponsible, so they have somebody control that for them, right? That's generally what a trust would be. And generally the structure of a trust, you'll have yourself as the grantor, you'll have yourself as the trustee, and then maybe you'll have your kids as a beneficiary. This is called a revocable trust, a revocable living trust. Because if you're the grantor and the trustee, when you grant assets into the trust or gift assets into the trust, you never really gave up ownership or control of the assets. So really, they still belong to you from an asset protection standpoint or from a liability standpoint. Like you can be sued in assets in a revocable trust, they can be got, because you never really gave up the ownership. Now, let's just say you were not the grantor. Let's say this was like your grandparent. Well, then this could create an irrevocable trust. And so the reason why I'm mentioning this is because there's different rules for different types of trusts. And this ain't a trust workshop or class, but just so you know, I know we on live right now, and I just don't want you guys to take exactly what I'm saying word for word and just think it'll automatically apply to your scenario. All right. But the way this trust is actually structured is it's structured as an irrevocable trust, which means it's not even my trust. I'm just the trustee. Is everybody with me? And because I'm the trustee, I'm in control. And the way the trust is written up, the grantor wants me to distribute 100% of that income to the beneficiaries. Because remember, trusts are set up for beneficiaries. All right. So let's just say, for example, actually, this ain't really an example. This is just real life. This is what I got. The beneficiary of that trust is this family trust. And this is where I'm a trustee. And then my wife is also a trustee. And then the beneficiaries are the kids. Everybody with me so far? All right. Y'all stay with me, because remember I said I got 5 policies. 5 IULs. Let's count them out. 1, 2, 3, 4, 5. Okay. Now, once that $450,000 throughout the year is distributed from the business trust to the family trust, guess what I'm going to do with it? I'm gonna put it through here, because that's 6% on the way in, 5% on the way out. That's 1% here. 6% on the way in, 5% on the way out. That's another 1% here, and another 1% here, and another 1% here, and another 1% here. Then it goes back to the trust. So does anybody got a calculator? How much is 450,000 times 5?
You took times 9?
Times 5, I'm sorry.
Oh,
2,250,000.
All right. So what's my total premium paid? $3,250,000. How much money did I make for the year? $1 million. But I'm getting credit on assets of 3.2 million. That's the power of leveraging the cash flow. And I say all that to say this, that's why there's multiple policies, because just like a real estate investor, when they buy one property and they pull out the cash, they go put it in another property, right? They build it up, pull out the cash again, they put it in another property. They use the same money to acquire 3 properties, and they just keep rinsing and repeating. That's called the Burr method. So basically what I'm doing is I'm using the Burr method in a life insurance policy, where I'm taking out the cash of one policy and using it to pay another policy. I take out the cash again, use it to pay another policy. And every time I leverage it up, I'm increasing my potential to earn money. More importantly, everybody in my family got a life insurance policy.
So Brandon, so this concept is similar, like you're taking the top part and you're actually doing a distribution and kind of doing a dollar cost averaging across the board.
Mm-hmm. Yep.
Oh, that's beautiful. That's beautiful.
Yeah. So that is it, man. I feel like I'm gonna be around long enough to see all this come into reality, because this is what we're actively implementing now. So
As long as you spend some of that on your health, you should be.
yes, sir. Yes,
Now
sir.
that's your greatest asset, because
It
if you
is.
don't live long enough, it don't even make no sense.
Mm-hmm. Yeah, I mean, Jeffrey said, and then the surrender value for each one over time would show as more cash available. That's absolutely right. Like, if we come back over here to the illustration, see, this loan is just pure cash flow. This 150,000, once I have it in my hands, I can do whatever I want to do with it. I can put it through another policy, pull it right back out, and then put it back in my business and pay my employees. And you can repeat that process over and over. That's actually how you can retain really, really good people that work for you, and you wouldn't be where you are today without them. You should probably want to keep those people around, so you might want to give them some benefits. This could be a benefit that you technically not really paying for, because you're just using the business's revenue and just funneling it through the policy and letting that arbitrage, that spread, that 0.5% grow. Power of leverage. Okay, let me see. We got about 9 minutes. Okay. Now I did want to cover this because everybody want to know how much it costs. So remember, your premium is not the cost. The premium is what you pay. The cost for the policy itself is deducted from the premiums you pay. So you pay your premium, whatever that amount is, there is a premium charge that is deducted. The remaining amount goes into an indexed account or a fixed account or a combination of both. So let's say if you had $1,000 and let's say they took out $50 for the premium charge, that means there's $950 left in your cash value. Okay, and it'll earn either index crediting or it'll earn a fixed interest credit for the year, or a combination of both. If you want to maybe put 50% in the index and maybe put 50% in the fixed account, you could do that too. And then one time each month, the administrative and insurance charges are going to be deducted from the fixed account first, and then from the indexed account, because the cost of insurance is deducted monthly. Okay. So that's why sometimes you'll hear people say bad things about IUL, because nobody told them that the charges are deducted monthly, and they just think that they can pay one time, not have to pay any money for like the next 2-3 years and still have a policy, which is technically true. But those charges are going to be deducted whether you pay a premium or not. And once you run out of cash value, your policy lapses. That's why you always want to continue paying premium, even if you're borrowing against it. All right, now let's break these down so you can see numbers. Also, the way this contract is designed, the maximum premium per year is $100,435.21. So the charges are going to be based on that number. Okay. But in terms of a percentage, they're going to be the same generally. Okay. So year one, we got our total premiums paid, $24,000 for the year. The total premium charge. Now, this number is always going to be different. There are some companies that have 0% premium charge, but there are some companies that have 30% premium charge. This one has a 5.5% premium charge. So no matter what amount of money you pay, 5.5% is going to be deducted. And what the premium charge covers is, if we come down here, right here, premium charge is applied to all premium payments to reimburse the life insurance company for state premium taxes and other administrative expenses. So because insurance is not regulated by the federal government, it's regulated statutory or a state level, all insurance companies have a state tax that they pay to do business in that state, because the state actually insures the insurance company in something called a state guarantee fund. So you can research and look a little bit further, and we ain't going down that rabbit hole today. Now, the next charge is your cost of insurance. And this is based on your age, health, and the amount of policy. And these are all annual numbers here. So you can see in the first year, my cost of insurance is only, what is that, $21 a month, something like that. You guys see that? This is generally going to be the same regardless of the company, because The insurance companies are like hundreds of years old, and let's just put it this way: people have been dying for a long time. So they got a pretty good idea on how to price a life insurance policy so that they can make money and make sure that they can pay all the claims. All right. Regardless of the company, is my point, your cost of insurance is generally going to be the same. What'll be different is your premium charges and your policy issue charges and your rider charges, because those are going to be like just different from carrier to carrier. Now, this policy issue charge, again, is based on a $1.5 million death benefit. What the policy issue charge does, let's go read our chart here, to help cover the cost of issuing, underwriting, and distributing policy. Underwriting, paying the people at the home office, distributing, advertisements, marketing, agents, all go into that policy issue charge. That's basically how they make money. And not they, the agent, but also the insurance company, the underwriters, and everything like that. That's essentially the policy issue charge. And as you can see, it's only for the first 10 years of the policy. After the first 10 years of the policy, well, let's look at what happens to it. Where's it go? It's gone. You gotta see that. Now, you got to be careful here, because I've seen policy issue charges that go out for like 15, 20 years. Okay, just something to think about. Next one is going to be additional charges, and these are going to be riders. So you remember that early cash value, the early cash value rider? Y'all remember that? There's a charge for that. There's also chronic illness, meaning if you can't perform 2 of the 6 daily living activities, like eating, going to the bathroom, getting dressed, getting in and out of bed, walking, driving, like if you can't do 2 of those 6 things at the same time for at least a period of 90 days, then you qualify for the accelerated death benefit of the chronic illness, which means you can get money, the death benefit, while you're alive to cover in-home care. And they don't check exactly what you spend it on. Like you can get that to your, your cousin or somebody or whoever going to be taking care of you. You do whatever with it, right? Also, you got accelerated death benefit for terminal illness. So doctor says you got 12 months or less to live. They'll generally give you like 70 to 80% of your total death benefit while you're still alive. This actually happened in real life to one of our agents back in 2019. She was diagnosed with, I don't know exactly what she was diagnosed with, but she had a policy, got diagnosed with a terminal illness. She might even be watching right now. If she is watching, go ahead, chime in on it, or you can just tell us the story yourself. But she got like $700,000 lump sum because she was diagnosed with a terminal illness. She's still living, breathing. I see her traveling all the time. She's doing her thing. So that's nice. Also, waiver of premium. So what that means is if you get disabled, you can't do your job, the insurance company will actually waive your premium. They will pay it for you, basically. They will pay your premium for you, and you can still access the cash value out of the policy. So let's just say if your premium was like $2,000 a month or $3,000 a month, and they're paying that for you, and you get disabled. That's a nice little something, How many people been disabled before in real life? How many people been on disability and wasn't really disabled getting them checks? I'm just playing.
In this case, would the disability be the same thing as a chronic illness in this case?
It's not exactly the same thing. So disabled just means, let's say if you're like a surgeon or something, you can't perform your job as a surgeon, then now you're disabled from your occupation. And because you can't do your occupation, you can qualify for the waiver of premium. Whereas a chronic illness would be something like you can use your hands, but you can't get in and out of bed. You can't go to the bathroom by yourself. You need help eating, things like that. It's a little bit different there. And those are generally things that are going to happen when you get older. That's why it's a good idea to get them like when you're younger, because when you're older, they cost a lot more. And usually you don't get it until, or think about getting it until after it happens, or it happens to somebody and they don't have nothing. And then you laying up awake at night, worried and scared. Then somebody take advantage of you because you make an impulse buy because you see an ad on Facebook. Buy this now. I'm just saying. I keep it real, y'all. So anyway, where were we going with that? That was the last thing. So those are pretty much your rider charges. And as you can see, these rider charges go all the way out through, well, they're the highest in the first 10 years. And then they continue through really age 59. This one falls off. So this is the disability provision, right? Or the disability rider. So some riders only stay on for a certain amount of time, like the disability rider. And then once you reach a certain age, it just falls off. And then that's why you see the additional charges go down to $60 for the year.
I was gonna say, touch on those bonus interest credits, and then the far right column, the interest credits.
Oh, okay. Yeah, because everybody's like, dang, they're taking a lot of money out. Okay. So here is everything that is, well, from here to here. This is all cost for fees. Okay. And then this is what is earned, or the credit, at least in the first year. You guys see it? And then, of course, you got your cash value and your surrender value. We already covered those. I'm going to fast forward down to the 10th year or to the 11th year. And a lot of companies have these. Some of them have them right out the gate where you can get these bonus credits in your policy. But some of them make you keep the policy at least 5 or 10 years before they start giving you this bonus interest credit. But what the bonus interest credit is a reimbursement. So it's not a guaranteed credit. It's based on really the profitability of the insurance company. So it's a reimbursement of expenses. It's the insurance company saying, hey, we charged you too much this year. We're going to give you some money back in the form of a bonus. That's basically what it is, to keep it simple. All right. And so this one has that bonus starting in the 11th year. And it's usually going to be a percentage of whatever your total cash value is. And I know it looks like a lot of charges, but then you also got to look at what you're being credited as well. That money is coming out to cover your cost of insurance. And then this money is credited and growing. Then what happens is the credits begin to cover the cost. They actually more than cover the cost. That's how you grow cash value. That's how you get more cash out of the policy than what you actually paid in premiums. So that's how it's an investment, not a security investment, but a good place to save cash. I got to put that as a disclaimer because there'll be people watching and be saying life insurance ain't an investment. And I totally agree. It's not. Neither is a house, but it's still an asset. And I think most people would rather own a house than rent a house. We'll take that for what it's worth. All right. Any questions? Let me check in the chat. Is it better to pay monthly or annually? Okay. It's actually better to pay annually, assuming your agent dollar cost averages your policy. Actually, you know what? I'll just show y'all. How about that? Because I told y'all this is a new policy, and I started it with like $14,000. And remember, that's just money from the business. So business owners, put money back in your business and save some money from your business.
Mm-hmm.
And so I told myself I'm gonna put this money there and I ain't gonna touch it. In case y'all think I was making this up tonight. I'm gonna show y'all the proof. Like, he ain't got no policy. So what it say? Welcome, Brandon Anthony Clark, LLC. I paid a total of $14,000 minus my cost of insurance. That's my net account balance or total balance. Okay, everybody see that? So right here, values and allocations. Let's say if you had a lump sum of money and you wanted to pay it all at once into your policy, you want to have the agent dollar cost average the policy. That way you don't have all your money going in one crediting segment. Y'all got to come in next week because next week, I promise we're going to look at crediting segment because what I'm about to say right now ain't going to make a lot of sense. I'm going to do the best I can without a visual. But basically, there's 12 crediting segments per year each month. And so if you're paying monthly premiums, you don't really have to worry about it all that much. But if you have a lump sum of money and you'd rather put that money in the policy all at once to get more interest right away, then you would want to have dollar cost averaging set up. And that's basically what I did here. So I put $14,000 one time lump sum. And what they did was they put that money in the interim account. And what's going to happen is on the third Friday of this month, which will be next Friday, the 15th, actually, this Friday is the third Friday. So on Friday, they're going to transfer all of this money into this fixed account B dollar cost average. Everybody with me? And then what it's going to do from that point is it's going to automatically divide whatever this number is by 12. And then it's going to transfer that money, that amount, 1/12 of that amount into the S&P 500 index. And then that begins a segment for the year. and it'll automatically transfer that money into the segments each month for you. That way it spreads out your lump sum. Let's just say, for example, you put in a lump sum and you didn't dollar cost average it, and your return was 0% for that month. When then 0% would be your return for the year. But what if you spread it out and maybe you have 5% in one month, 10% in another, 6% in another, 3% in another, 10% in another, right? Well, then what happens is you're giving yourself more opportunities to earn interest as opposed to having everything in one. Let's take this, for example, free throws. Let's say you got chosen to shoot free throws to win $1 million. Would you rather have one shot or 12? 12.
12.
Right? So when you dollar cost average, it's like giving yourself 12 shots to earn interest for the year on entire cash values, or at least whatever's in that segment. That makes sense? All right.
I got a question for you. When I signed up for my policy, I got a $500,000 policy, but he was telling me it didn't matter. Just pay it monthly. You don't have to pull out the lump sum, but I have the lump sum to put it in for the annual. I did some fact checking a little bit, and I think I'm going to change it in the new year to the annual so I can gain more because I'm, in the stock market as well.
Yeah.
I think that's what's best. I just didn't feel like he was being as clear, but I saw your policies in your LLC. I did mine under my personal. I did want to open up another policy, and I don't know if you do that, but I would like to open up another policy under my LLC as well.
Yeah.
So when they do a health check behind that, how would they just go off my DBA, which is me?
So they would still insure you. Like you would still be the insured person, just the business would own it.
Okay, got it. Okay, so simple title change, pretty much.
I mean, you could change the one you got right now. You could just change the ownership. You don't necessarily have to get a new policy. It's literally a quick change of ownership form.
Okay.
Probably have to fill out a W-9 for it, but that's something that your agent for sure can help you with, definitely.
And then also, the only thing that'll always remain the same is going to be the insured. You can always change the payer, the owner, and the beneficiaries. Those can always change at any time.
Thank you. 10-4.
Welcome, man. That's a really good question. I appreciate you for asking it, because I know people was wondering. It'd be like that. All right, you guys. Well, if we don't have any other questions, we're gonna head out for tonight. Again, we'll be back again next Tuesday, 5 o'clock Pacific time. Go ahead and make sure you register. You can use the link in the bio, register. We'll be doing these every week on Tuesdays. I know we got some agents on the call. We're going to start doing some agent training as well, because there have been some people that have reached out and want to learn how to design policies the way we design policies. So we'll be launching that in the beginning of the year. All right. I appreciate everybody's time. It's been fun. It's been real. I look forward to talking to y'all again next week, and y'all take care. Stay blessed. All right.